You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 2nd of July 2024, and I'm joined by my co-host John McEwen. In this week's episode, we'll be discussing Halma, Cranswick, Tesco, AJ Bell, Bellway, and our US company of the week is Etsy. John, do you want to start us off with Halma?
Yes, so Halma, we have covered them before, and they've had their full year results out last week. And just as a reminder, they have businesses which are in safety, health, and the environment. They describe them as fairly defensive sectors, and that is one of the, I suppose, attractions to it, as well as significantly growing the business in overseas markets. Some of the businesses that they have include ones that specialise in fire alarm brands, gas detectors, water analysis, hlma medical equipment, blood pressure machines, ECGs, all of that sort of thing. Anyway, they had their full year results out with full year organic revenue growth of 8%, ignoring currency impacts, to £2 billion, and underlying operating profit grew 7% to £424 million, which was ahead of expectations. There are 8 acquisitions completed, totaling a maximum of £292 million, and one has already been completed in the new year, totaling £44 million. Net debt, including leases, rose by £56.5 million to £653.2 million, or 1.35 times cash profit. Due to higher profits and efficient working capital management, free cash flow rose from £293.2 million to £435.1 million. And the new year has started well, with Halma aiming to deliver good organic revenue growth in the coming year. Underlying operating profit margin is expected to be around 21%, which is in the middle of its target range. And a final dividend of 13.2 pence was announced, taking the total to 21.61 pence, and that's up 7%. And the shares were up nearly 7% in early trading. In terms of valuation, Halma has a market cap of £10.1 billion and trades at 26.5 times forward earnings, compared with a 10-year average of 29, and it has a prospective dividend yield of around 1%. I thought these results were decent. However, it is an expensive company to buy. It seems to be largely acquisitions, and I'm not sure that they have the highest quality brands or technologies with real moats around them. And I think that would be my concern going forward, particularly at that valuation. So it would probably be one that I wouldn't look further at. I think there would possibly be a price at which I would, but it's not that. And I think within the portfolio, as I said before, the brands aren't the highest quality. So it would be a no overall from me, although you can't really argue too much with this set of results. Sam, what are your thoughts on Halma?
Fairly similar. I think these results are pretty good. I like the acquisition strategy in that they're paying for it out of retained earnings mainly. And the acquisitions are being funded by the profits of the business because the debt hasn't really gone up. I think it's expensive at 26 times earnings. I don't know anything about the brands and the quality of them. I just don't have any expertise in that area. It kind of reminds me a bit of Gamma Communications in terms of sort of the strategy, I guess the growth figures as well, and the price. I think that's just, unfortunately, for these kinds of businesses, it is just what you have to pay at the moment. But yeah, if I'm not comfortable with the business, I just wouldn't look any further. But it looks like a business that could be quite well run on first glance. And it definitely doesn't look like a terrible business, but just not enough to interest me.
Yeah, fair enough. Out of interest, I will just have a look at the share price performance. Okay, so over 3 years, and I appreciate they're not paying out much as a dividend, it's up about 3.5 times. And over the last 5 years, it did have a bit of a rally post-COVID, but it's up by about a third. Just a decent share price performance. Obviously, completely different businesses with Gamma, but it's a much bigger business in terms of market cap. yeah, I suppose the brands are something. The ones that I know in there, and one of them being Keeler in terms of the medical devices, I certainly wouldn't put right up at the top. I do own one of their products, but yeah, tricky to say, I think, with some of the others, because I'm not as well versed on fire alarm brands. But anyway, shall we move on, Sam? Company that we've covered quite a few times on the show now and is very easy to understand.
Yes, Cranswick. So for anyone who's not familiar with the business, they basically just make meat. So very easy to understand. So they have come out with their full year results. Revenue was up 11.9% to 2.6 billion, and adjusted group operating profit was up 26.3% to 185 million. Statutory profit before tax was up 13.5% to 158 million. And statutory earnings per share was up 1% to 210p. The dividend was increased by 13.4%, and that gives 34 years of unbroken dividend growth. Return on capital employed was up from 15.8 to 18.5%. Free cash flow was 223 million with a free cash conversion rate of 142%. Net debt was down to 0.1 million, down from 20.2 million. And they have a 250 million pound bank facility providing significant headroom. We've said on a comparable 52-week basis, revenue was only up 9.8%, which reflects effective inflation recovery and underpinned by 4.5% volume growth in UK food, with growth accelerating throughout the second half of the year. They had 98% fulfillment across their product portfolio, and the adjusted operating margin increased from 6.3 to 7.1%, reflecting a strong contribution from the expanded pig farming operations, tight cost control, and robust returns from the effective deployment of capital. They've said their substantial ongoing investment in feed milling and pig farming operations to ensure security of supply and drive enhanced returns. And they invested 46 million in two strategic acquisitions. 32.8 million was the acquisition of hlma indoor pig farming business, which further diversifies the pig farming operations and adds additional feed milling capability with self-sufficiency in UK pigs over 50%. And the 13.3 acquisition of Frock Foods, adding further cut meat and bacon processing capacity. Total capex was 91.4 million, and that's to add capacity, capability, and drive operating efficiencies. They mentioned that they've got 3 earnings-enhancing capital projects totaling 112 million in progress, with 17.1 million spent in the year. And that is a 62 million multi-phased expansion project ongoing at the Hull pork primary processing site, 23 million fit out of new hummus factory at Worsley, Manchester progressing to plan, 27 million expansion of value-added poultry across both Hull sites now underway. I think from last time, do they have the Ramona's hummus?
Possibly.
Yeah, they do. They have Ramona's Kitchen. So any of the Ramona's products is owned by Cranswick. Oh yeah, and they've invested 10 million in Lincoln Pet Food site, which is nearing completion with new national retail customers on board. I spoke to someone who worked at Cranswick a couple of years ago, and they were saying that Brexit had actually been a massive, massive positive for them, because what it's done is it's driven this big push for like British beef and British pork and stuff like that. And, you know, demand is just outstripping supply. So it's quite a good business to be in at the moment. I do quite like as well how, in terms of the range of products, which again, we've covered in more detail previously, but they kind of do the full range of animal products. So, you know, with the lower quality meat, they're now doing the pet food, or they're going to be doing the pet food, food very, you know, so they're using every part of the animal as much as they can. It's efficient.
Yes.
In terms of the valuation, the business trades at a PE ratio of 18 and has a dividend yield of 2%. In the last 5 years, the shares are up 70%. I think this is a very good business. I think it's another good set of results, which we have become used to. I think it's a quality business. It's easy to understand. I think at 18 times earnings, there's probably other businesses I'd prefer, but I think you can make a very strong investment case for Cranswick, and it's definitely a business that's grown on me the more we've covered it. What about you, John?
Yeah, and I think I would echo that, and I would say that it does have an impressive return on capital employed, and I think that they're expecting to be able to grow that a little bit more as well. And yeah, it seems to be very well run, growing the market share. And if I were to say anything on the bear side, I guess it would kind of be with more popular vegetarianism, veganism becoming more popular, whether that has any impact. I think if you looked at it globally, and even as our population increases, I don't think that is too much of a concern. So yeah, I like it. Valuation, it is doing well. It's probably justifies it. I don't know whether I buy shares, but I do like it.
I think though with the vegetarian issue, if you'd call it an issue, but the risk, I just think with that, I don't see demand for animal products going away anytime soon. I know we have talked about this before, but
Yeah,
there's certainly in terms of the feed and stuff, that's not going to go anywhere.
yeah.
You're not going to have vegetarian dogs.
Well,
They have bought Ramona's Kitchen. I know it's only a
yeah,
small part of the business, but at least they have some exposure to what
yeah,
could be, a very fast growing part of the business. I think there's potentially more of a threat from like lab grown meat, but they'd probably just buy you probably just acquire something. If that ever got to a point where it's like it was, you were getting lab grown meat in shops and stuff, you would think they would just start producing that because it doesn't seem like something they'd be incapable of doing. So I think sort of whatever way the industry does go, I think they're quite well positioned for it. I think they have shown in, the years we've been covering them that they are a well-run business,
yeah,
which I think is the main thing for stuff like that with the unpredictables.
yeah. Okay, on to Tesco's.
Yes.
So, favorite of the show. It's a stock that I used to own until probably about a year ago when I sold it. But they had their Q1 trading statement out. So, in terms of sales performance, 13 weeks ended 25th of May 2024. For the UK and Republic of Ireland, sales came in at 13.33 billion, and that was up 3.6% on a like-for-like basis. The UK was up 4.6% and Republic of Ireland 4.4%. Unfortunately, Booker was down 1.3%, and Central Europe, which only accounts for £975 million worth of the sales, was up by 0.6%. So in total, retail operations were up 3.4% or to £15.3 billion. The chief executive, Ken Murphy, said, "We've continued to build momentum in the business with a strong volume growth across the UK, Republic of Ireland and Central Europe, supported by easing inflation. We continue to be the cheapest full-line grocer and are the most competitive we've ever been with our value, product quality and service driving better brand perception and customer satisfaction. Our market share reflects this, growing more than at any other time in the past 2 years, with customers switching to us from other retailers, shopping with us more often and with more in their baskets. Following another strong quarter, we're pleased to reiterate our guidance for the full year with sales trends in line with our expectations and the business well positioned for the months ahead." Other performance highlights: strong market share performance and strengthening volumes, with market share growing ahead of all competitors, up 52 basis points to 27.6%, supported by 15 consecutive periods of positive switching gains. Food sales were up 5%, including strong volume growth across the quarter, particularly in fresh food. Non-food sales were up 0.7%, driven by strong growth in clothing. Cheapest of the full-line grocers for 19 consecutive periods throughout powerful combination of Aldi price match on 700 lines with low everyday prices and over 1,000 prices locked, and then also the club card prices. Growth in all channels, with online sales up 8.9%, driven by volume growth and strong contribution from Whoosh. Finest sales continued to grow strongly, up 12.5%, and net switching gains from premium retailers for 22 periods. In terms of Booker, continued underlying growth in core retail and catering following an exceptional performance last year. Core retail sales were up 1%, with further improvements in availability and 204 net new retail partners. Overall sales declined 1.3%, which reflected the continued tobacco market decline and weakness in parts of the fast food market. Coming on to the valuation then, Tesco's has a market cap of just under £21 billion and trades at 11.2 times forward earnings, compared with a 10-year average of 12.5, and has prospective dividend yield of 4.5%. I thought these results were decent. I think they're on the back of strong results that we've continued to see from Tesco since COVID. Massive turnaround of the business over it's probably longer than 5 years, but sort of 5 to 7 years, I would say. And it really is doing well now. The main reason I sold my shares was that I felt that it had become, much more saturated. Things had, improved operationally quite significantly. And I suppose I didn't really see, where the growth came, going forward. It's one of those stocks that we've talked about where it had the growth strategy, and that was something when I first bought the stock, potentially more exciting when it was trying the US expansion, when it was trying expansion more in Central Europe, in Thailand, and it's had what proved to be a very unsuccessful strategy with some of those, but also it was buying up, it had the Tesco Bank, it had other businesses, and it was based, I suppose, on the theory that there was more going to be hypermarket shopping and everything that you would do would be at Tesco's. And then this model was going to be essentially was being rolled out worldwide. It badly backfired on them, but now back to the core business, which is being run well. But I think the growth is not there for me. And that would be the main reason, even though I think they're fairly priced shares. In fact, they look relatively cheap for some of the performance that they have delivered over the last few years. It's that would be the reason that they wouldn't be for me at the moment. But I suppose depending on what you were looking for, and if you were looking for more of an income play, then they are, fairly attractive with a 4.5% yields. So I think you could certainly do a lot worse, but I guess it does boil down to, ultimately what you're looking at from a stock. Sam, what are your thoughts on this trading statement and Tesco's as an investment?
I thought it was pretty good. I think we did their last results pretty recently, but they're doing quite well. So they thought they'd give us a trading statement, as they so often do. I saw the market share had actually grown another 0.5% to 27.6, which, considering how impressive it already was, I think is very, very good. I saw as well the CEO's come under fire for his £10 million pay package.
Oh, really?
Shareholders voted for it, and he accepted that he was well paid, as his salary more than doubled to 9.9 million for the year, driven by a performance-linked bonus of 8.3 million. But I think he's doing a great job in terms of the company performance, and given it is performance-linked, I think it seems pretty reasonable, given how well they're actually doing. But yeah, not loads else to say, given that we covered them fairly recently, and they're just sort of continuing to plug away quite well. So should we move on to AJ Bell?
Yes. So you've recently sold your Hargreaves shares. How are AJ Bell doing?
So they're doing pretty well, actually. So their revenue was up 27% to 131 million. So these are the interim results. They've come out, their interim results, and revenue was up 27% to 131 million. Profit before tax was up 47%, 61 million. Profit before tax margin was up from 40.4 to 46.8%. Earnings per share was up 40%. Dividend per share was up 21%. Number of retail customers was only up 5% though, which I think is quite low, given that they're meant to be trying to take market share of Hargreaves. they're not going to be taking very much there. Customer retention rate down slightly to 94.5%, which is still a couple of percent above Hargreaves. They've now crossed over 500,000 customers for the platform business, and platform assets under administration were up 13% in the first half to a record 80 billion, driven by net inflows of 2.9 billion and favourable market movements of 6.5 billion. In terms of the valuation, the business trades at a PE of 23 and has a yield of 2.8%. I think for me, these results are obviously excellent, primarily driven by, I think, obviously the stock market movements. Interest rates are still pretty decent. I think in terms of the customer numbers, if I was paying 23 times earnings, especially when you can get Hargreaves, or you could have got Hargreaves Lansdowne for 10 prior to the takeover offer. If I was paying 23 times earnings, I'd want customer numbers growing by more than 5% a year. Because I think in terms of the rest of it, it's pretty cyclical. I know the assets under administration is doing very well, but that's been primarily driven by how stock markets are doing. In terms of what they're adding into the platform, it's not that high. And I think that would be a concern given how cyclical it already is. Whereas you could maybe make an argument for 23 times earnings, if customer numbers were bombing away, you thought, yes, it's going to be cyclical. But at each cycle, the revenue is going to be higher than the previous one because of all these, this market share they're taking. And I just think that isn't happening. I suspect what's happening is you're getting these challengers like, I know it's not things like this, but like the Robin Hoods, the free trades, and they're actually taking a chunk out of AJ Bell and Hargreaves. So although AJ Bell is smaller than Hargreaves, it's still got a similar problem to Hargreaves, I think, as well as just the fact that people are quite lazy and they are quite sticky products. So getting them to move over from Hargreaves, even if it's cheaper, I think has proven easier said than done. Yeah, I think these are an excellent set of results, but bearing in mind the cyclicality, I don't think I'd want to pay 23 times earnings for it. What about you, John?
Yeah, no, I would agree. I think I've said before, I think very competitive market. I think there is an element of it becoming commoditized. And yeah, decent results. You can't knock them, but that would be my worry. And I don't think they are, well, they're not cheap shares either. Do you think they would be or might be a takeover target?
It's a good question. Market cap's only 1.5 billion. It's more expensive though. I think Hargreaves was just so cheap.
Yeah, yeah.
I don't know, because I don't think the numbers it's putting up are actually that dissimilar to Hargreaves, given that you're paying double. If I was a PE firm or whoever else looking to buy this, whoever suggest, I'd be sat there thinking, oh, I wish we'd bought Hargreaves. I don't know at this valuation because you're going to expect some kind of premium on top of it. So then it's, a PE firms. I know I'm just using PE firms as an example, but they do tend to be the type of firms that are buying up FTSE listed businesses at the moment. But is a PE firm going to pay 30 times earnings for a business? Like maybe they will, but I just think it's maybe the share price needs to get cut in half before someone takes a look at it.
Yeah, no, fair enough. Okay, on to Bellway then.
Yeah.
So House Builder, we've covered them before. They had a trading statement out from the 1st of Feb to the 2nd of June and highlights stronger trading growth through the spring selling season with improved affordability, supporting an increased customer confidence and reservation rates compared with the first half of the financial year. Private reservations rate per outlet per week came in at 0.62, which was up 6.9% compared with the prior year, which was 0.58. Overall headline pricing has remained firm and incentives continue to be used on a targeted basis, reflecting the improvement in trading and growth in outlet numbers. The forward order book has increased from the level of 4,411 homes at the start of the current financial year, and the forward order book as of the 2nd of June comprised of 5,346 homes. And in line with the previous guidance, the group is on track to deliver full year volume output of around 7,500 homes. From the 31st of July 2023, it had been 10,945 homes, and they continue to expect a reduction in the underlying operating margin of at least 600 basis points from the level in the prior year, which was 16%. The overall average selling price is now anticipated to be around £305,000, and that's down from £310,000 in July last year. The increase from the previous guidance of 295,000 is mainly due to changes in product mix. The group is now fully sold for the current financial year, and given the strong outlet opening programme and healthy forward order book, they are well positioned to return to growth in financial year 2025. And Jason Honeyman, the group's chief executive, commented that Bellway has delivered a solid trading performance supported by improved affordability and seasonal uplift through the spring, and we remain on track to deliver full year volume output of around 7,500 homes. We've been encouraged by the ongoing healthy levels of customer interest, and combined with the strength of our outlet opening programme, we continue to expect a year-on-year increase in the forward order book at 31st of July 24. As a result, Bellway remains in a strong position to return to growth in financial year 25. We iterate our confidence in the group's robust balance sheet and operational strength, combined with the depth of our land bank. In terms of valuation, Bellway has a market cap of £3 billion and trades at 7.7 times earnings with a prospective yield of 5.5%. I thought this was fairly mixed. I think it has been kind of what we've got used to with some of the difficulties that the house building sector has been having in the past couple of years. And of course, it is reflected in the valuation. I think going forward with a lot of the house builders, and I appreciate some of them operate at different ends of the market, and some of them have larger scale and different product mix than others. But I think broadly speaking, given, as we've talked about, the sort of structural imbalance and the huge demand for housing in the UK, and particularly, more affordable housing, and the very short supply, and all of the political commitment, and this would apply to what looks, according to the polls, like it will be a Labour government, that there is going to be a strong commitment to it, and particularly or potentially relaxing building on the green belt. You would expect this to be quite a big boom for all of the big house build, or most of the big house builders at least. So I would, as I have before, be bullish on quite a lot of them, even though some of these results are fairly mixed going forward. And I appreciate there have been a bit more of a rally with quite a lot of the house builders over the last 6 months, last year, as that's, the horizon has looked brighter, and particularly when it comes to interest rates, the expectation being that they would gradually fall. Sam, what are your thoughts on this trading statement from Bellway and, I suppose, house builders in general?
Pretty similar. I do think it's interesting that this is maybe the first one we've seen in a good while where the order books actually started picking up again. So I think that is interesting and does reflect sentiment quite a bit. I agree. I think what it does look quite likely that the next government is probably going to be favourable to the house builders, and not just Bellway. Bellway's, I think, pretty reasonably priced, strong dividend, but I don't think there's anything wrong with taking a basket approach to the house builders, because I think as a sector you would expect it to do very well. I think we've got political parties at the minute in the run-up to the election talking about the number of homes they're going to build. Historically, previous governments have not built the number of homes they've said they would, and I probably would go forward on the basis that's not going to change. But I think in any event that it's going to be positive for the house builders, because there is obviously going to be more focus on trying to build new homes, which I think can only be a good thing for them. So yeah, I like the sector. I think Bellway looks like a decent stock, but I do like a lot of the house builders, so I'd probably just take a basket if I was to do it.
Fair enough. Okay, final company of the week, and one that you own personally, Etsy.
Yes, Etsy. So these results are a couple of months old, but there wasn't really anything I was too fussed about covering recently, and I also haven't looked at them yet. So Etsy have come out with their Q1 results, and gross merchandise sales were down 3.7% year over year to 3 billion, and that was down 4.1% on a currency neutral basis. The marketplace gross merchandise sales was down. The Etsy marketplace gross merchandise sales was down 5.3% to 2.6 billion. Active buyers, however, increased 1% year over year to 91.6 million. And United States active buyers grew slightly for the third quarter in a row. 6.3 million buyers were reactivated, up 5.9% from the prior year period. Gross merchandise sales per active buyer declined 3.5% year over year. However, that trend is showing signs of stabilization. The number of habitual buyers was down 2.9% year over year to 7 million, although the retention rate was slightly better. US domestic gross merchandise sales represented 52% of the overall. Consolidated revenue was up 0.8% to 646 million, with a take rate of 21.6%. The modestly positive revenue growth was primarily driven by growth in payments revenue, transaction fees, revenue from offsite ads, and Etsy ads. Consolidated net income was 63 million, down 11.5 million year over year, and consolidated net income margin was approximately 9.8%. Etsy ended the first quarter with 1.1 billion in cash and equivalents, and in the first quarter, $158 million of stock were repurchased, and that's on a market cap of 6.77 billion. So if they were to do that every year or every quarter, that would equate to about just over 9% of the stock being repurchased a year. In terms of the valuation, the business trades at a PE ratio of 26.5, but the price to free cash flow is only 10. And this is something we've highlighted a number of times. These results are not great. I think they're also not terrible. I think they've saved themselves by the fact that they've got the ads coming through. So although the people are spending slightly less, they are still increasing the revenue ever so slightly because of the ads. However, buyers is still going up. I do think some of the decrease in spend per buyer is more to do with economic factors than Etsy specific. I think the amount of cash it generates is absurd. I think the repurchases is very healthy. I think the share price is so cheap mainly because of concerns over competitors. However, I still think Etsy is a pretty unique website, and I think it will take a lot to dislodge it. So as a shareholder, I'm quite happy with this valuation. I did catch my girlfriend on something fairly similar that was owned by Alibaba a few weeks ago, so she got telling off. But I think overall, most people will be sticking with Etsy. We'll see if I'm wrong, but yeah, I just think these results are not fantastic. But I would hope that if the economy picks up a bit more in the US and overseas, that discretionary spend would start to increase and that would flow through. And if they've been increasing the number of buyers in the meantime, that's a positive sign that they're doing the right things. So, John, as someone who's slightly less biased, what's your take?
Yeah, I mean, I would like to agree with your investment case, and it may well be right. I suppose my view would be that the results are disappointing, and my major concern would be about the competitors. And I'd bought Boohoo shares a few years ago, and I'm not comparing the quality of Boohoo with Etsy, but with some of those competitors from China, does Etsy have enough of a kind of a moat with the sort of products it sells to be able to compete with some of those slightly cheaper competitors from China? And Boohoo, it hasn't been the case. And I mean, I'd be delighted because I still do own the Boohoo shares to be proved wrong on that. But I really worry about Etsy from that perspective. And I think probably because I've been burnt, once before, I'd be avoiding them. I like the web. Oh, I like Etsy as a whole. I use the app. I'm an Etsy customer, and hopefully it is just the cyclicality of things with more cost of living pressures that's to account for this. And hopefully, as you say, they're increasing the number of customers. If when things pick up, they can convert that back, and it's all very healthy, and growth returns. Fantastic. But that would be my worry, and probably why I wouldn't be buying shares.
I just think, in terms of what it offers, I think it is the go-to place in the West for unique items, gifts, stuff like that. It's got a nice little niche there. If you want to get someone a special gift, do you want to go to some Chinese website? I know a lot of the stuff on Etsy probably does come from China anyway.
Yeah.
But I think there's the perception, and I think it's very, very interesting. It's kind of like if you want to bid for something, you do still think eBay. There might be Chinese competitors, but you still go to eBay. And I think Etsy has been around long enough that it's in most people's mind, it's entrenched as a place to go for gifts. There might be some people that go to save money to something else, but I think people trust Etsy. They know it. I think I do recall making a similar argument for Hargreaves Lansdown, which was proven wrong. But I do think in 2 or 3 years, Etsy will still have a very similar amount of market share. I think it will still be churning out a very similar amount of cash, hopefully more. But yeah, I appreciate why people maybe are concerned, but I think because of the nature of what Etsy is and the kind of products it sells, I think there is a moat there.
Would you be topping up, given the market sentiment and how it's valued at the moment?
I would, but it's been at a similar price for a couple of years now, and I've already topped up a few times. So it's quite a decent position for me anyway. I wouldn't be against topping up again, but it's not like I've bought in 3 years ago at the peak.
Yeah.
And I've got this chance to really sort of bring my average. Like I've already topped up a number of times at similar prices, but I wouldn't be against it. I don't think it's quite the same as like Fiverr or Upwork, where I look at them and think, well, actually, I would quite like to increase my allocation to those. I think with Etsy, it's already a decent enough size.
Fair enough. Certainly an interesting business to follow, and yeah, we will continue to do so.
So of the 6 businesses then, Halma, Cranswick, Tesco, AJ Bell, Bellway and Etsy, which do you like the most and which do you like the least?
Ooh, tricky. I like the house building sector, and I do own Redrow. I don't think there's a lot to get excited about just on the basis of that trading statement, but I think the sentiment definitely with the house builders at the moment. I think of the companies, probably Cranswick. and that would be my top pick. I think last I would go. That's tricky. Probably go AJ Bell actually, but a very good set of results. Can't dispute that.
I'll exclude Etsy because I own it. Probably Cranswick, I think, would be my favourite. I think that's probably the best business. Oh, actually, I do like Tesco a lot. I think I'll go with Cranswick. I think his business has grown on me, but Tesco is probably a pretty close second. Least favourite, probably Halma, I think.
Okay.
Although it could be AJ Bell, but I don't particularly like either of them. In fact, it would be AJ Bell because having been burned with Hargreaves, there's no way I'd buy another business like that.
Okay. Fine. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.